major averages try to recover from their worst week of the year. My next guest says while investors should expect to see some more upcoming seasonal weakness, the setup looks bullish for stocks into year end. Let's bring in BofA Securities' Stephen Suttmeier. Stephen, great to have you on here. So I guess the question is, how would you know when the market is maybe tripping into something a little more worrisome than just, I guess, some typical seasonal churn at this point?
Right. I mean, that's the whole trick right here, is determining whether it's just seasonal or if it's structural. And I would argue it's more seasonal. First and foremost, I mean, everybody knows September is weak. But what a lot of people don't know is that weakness can carry over into October and election years. So you tend to get a pre-election pause in the market followed by a post-election year-end rally. Another reason why we think it could very well be just a seasonal pullback is if you look at market breadth, and I know you were talking about breadth with your last guest, the S&P 500 advanced decline line, NYSE advanced decline line, even the NASDAQ 100 advanced decline line have gone on to new highs. And what's interesting about that is new highs for the advanced decline line are a leading indicator for new highs on the indices, meaning that the S&P sometime in the future should surpass its high that it hit in July, around 5670. So those are a couple things that we're looking at here. So we think it's more seasonal rather than structural. So we do think that seasonality offers an opportunity to buy into the market ahead of a year-end rally in our technical view.
And there has, along with whatever's happening seasonally and along with maybe some moderated growth expectations that are filtering into the equity and fixed income markets, there has been this struggle to figure out what might lead the way. You've had this momentum sector of the market really has come in pretty hard. Maybe, yes, most stocks are up, but what are the themes that seem to be poised to lead at this point out?
Yes, so I think we're seeing rotation, as a lot of people have been talking about. And, you know, as a technical analyst, we view that as the lifeblood of a bull market. So you're getting sectors that are less extended starting to perform. Sure, there's a bit of a defensive bias with a little bit of a catch-up trade for the likes of utilities, staples, real estate, and healthcare. But where I think the real shift in leadership is standing out is more with the financial sector. You are seeing a lot of financials, including banks, insurance companies, capital markets companies, even some regional banks, breaking out of what technical analysts would call bottoming patterns and even big bases. So I think what has been to the detriment of the growth stocks and tech over the last couple of months has benefited names and financials, which appear to be could be very well a buy of a leadership group into the future. Another sector to keep an eye on would be industrials. I would argue that's a little bit behind what we're seeing in financials, but industrials, a lot of them have firmed up as well.
Is there a way, I mean, aside from essentially saying, you know, the uptrend remains in place, you should give the benefit of the doubt to maybe longer term advancing prices and breadth is good. Is there a way to try to handicap how much more upside we might have here? We're approaching, I guess, the second anniversary of the cyclical bull market, I guess.
Right. Yeah, I mean, the interesting thing about these cyclical bull markets is if you take big rallies off of big lows, which we argue that October 2022 was such a low, they tend to last about 4 years, and the market tends to rally on a median basis just over 100%. So, you know, a little bit more than halfway there. But near term, right here, right now, I think if the S&P can hold somewhere within this 5,400s to 5,300 range, and you know, just have a normal retracement of the rally that we got from October 5th into August 5th into August 30th, we could break through the range highs, and then you would form a pattern like a cup and handle or something like that would argue that you can make a move towards that 6,000 area in the market, which is, you know, not just that technical pattern. We have other sorts of models that we run in recent weeks and months that suggest that the S&P should be heading towards that level. Could be the end of the year if this pullback is shallow and we just rip to the upside, or could be the middle of next year, which is where the presidential cycle gets a lot less constructive on the market, meaning that you might see that midterm year type of interruption. So,
right.
So that's all the things we're paying attention to here.